It's been about 2 weeks since our last video on Halloween Day, where we decided that we were going to agree with the consensus that a Fed pause was going to occur. That the Fed had finished hiking, and that was going to be that. There was some allocation that thought that they were, and as of now, apparently not in the market pricing, thought that they were going to hike the rest of the year. We were comfortable seeing them pause. We believe that was a possible, if not probable, outcome, and that was our belief. However, since then, the market has had what I would consider the strongest move of the year, and we are certainly not in that camp for the reasons we discussed in that video. Lag effects, continued tightening in real terms as inflation continues to fall. And since then, that big rally, the rally that we're currently in the midst of, seemed to be most instigated when Powell actually spoke and when the market interpreted his messaging that day as being extremely dovish and decided to declare and react to victory. However, just a few days later, Jerome Powell spoke a second time. We had received no new data, and the market had a different interpretation of the same language he used. So I'm hesitant to believe what the market does, and therefore I don't. That's why for the past year plus, while this time I did agree with the consensus, I've been fighting notions, actively fighting notions of Fed pauses, of Fed pivots, of Fed rate cuts this year. If you've been watching these videos long enough, you know that is the truth of this channel. That is the historical take of this channel through this Fed hiking cycle. And it would just be nice if the market were a little bit more attuned with that this year, but obviously it hasn't been. We spent a ton of time thinking the October peak in rates was going to be the peak in rates, and all of a sudden it wasn't. Anyways, what matters today on this day when we're seeing the second day only ever of the year, not only ever, the second day of the year, with the S&P up more than 2% in a single day, we should remind ourselves that it is not the CPI which matters. It is the Fed action which matters. Theoretically, Fed action is supposed to be a trickle down from CPI data. But the market is claiming victory for the 69th time this year on 0.1% versus expectations. I guess it's completely disregarding the last month being not so much. And I guess they're ignoring the uptick, the increase in core services ex housing inflation, which we got today, which actually went up versus last month. And if you listen to when Jerome Powell gets pressed on this issue, he brings that up. Core services ex housing. So I am choosing to ignore the broader market outlook. I am choosing not to let price dictate my sentiment. And I'm choosing to look at the fundamentals. I am agreeing with Jamie Dimon that it seems like the market is overreacting to short-term data. I mean, 0.1%. It's not like nobody saw this number coming. This was like out of nowhere. We're all shocked. There were firms yesterday that thought we were going to get a 3.2% CPI print. Okay? So this is, in my opinion, crazy, but whatever. This past couple weeks has been pretty crazy. It's been the strongest move of the year. People thought they interpreted Powell correctly. They clearly didn't. Apparently they clearly did. I don't know, because actually I do know. I have my own take. The first speaker after the data, Barkin, says he's not sure, despite the data being good, he's not sure if we have to do more or not to cool inflation and demand. A lot of the talk is not around inflation. It's actually around cooling the economy. A sustained period of below-trend growth to be confident that we've gotten inflation under control. that when we begin to actually cut rates, that inflation isn't going to reaccelerate. So I prefer the more cool, calm, and measured approach, assuming we were at, relatively normal and attractive multiples. However, that's not the case. We are at quite elevated multiples. And while, yes, multiples have been higher than they are today, you don't want to be a buyer during those times. You don't want to be a buyer at those highest multiples. That's just not what you want to do. So, I look for deals. I don't buy stocks at highs. I don't buy stocks at high multiples. If that means I miss a couple opportunities, that so be it. But unless it's a young growth company, in which case the multiple really doesn't matter, if you're buying the index or talking about the index, you want to look for an attractive entry price. As Warren Buffett says, your margin of safety being the price being cheap enough that it doesn't matter what the market's going to do, what the Fed's going to do, that you're just buying a good cash flowing asset at a good price relative to those cash flows. That's what I do, and I don't think that is, on the index level, particularly attractive for fresh capital. That's just my opinion. It is subject to being incorrect. So multiples have been higher. They have been higher, but you don't want to be high. You don't want to be a buyer of them higher. That's historically not what happens, because what happens is, yes, we're not at the peak, but when you buy closer to those levels, you typically get lower multiples after that. Next, as the Fed says, the full effects of the tightening are yet to be felt. They fully expect additional economic tightening to occur, economic weakness to occur. They want a sustained period of below-trend growth. We just hit the new peak rates after peak rates had been achieved for a very long time. We just hit a new peak. And it's going to take months, not days, not weeks, not just a pullback in yields. It's going to take many months, if not a year plus, to actually see the full effects of that level, of that tightening. So I'm not ready to claim victory. I'm not compelled to buy stocks right now, other than particular few opportunities and areas. And yes, we are outperforming the S&P 500 today. Our fund is. We are up more than 2% today. Believe it or not, despite the rhetoric you're hearing in this video, that's how we're doing. We don't have, crazy stocks. We have cheap stocks. We have stocks like PVF, which we have written about, $43, $44 a share, which earned over $6 a share, not last year, not this year, last quarter, just last quarter. So that gets us into our next point, our next topic for today, which is oil. Oil has quickly become a punching bag for hedge funds. They are the most short since July, when oil prices began a vicious rally. And I'm not saying that is good enough cause to cause prices to rally. But in the past couple weeks, it's been a whole lot about recession, demand concerns, and it's astonishing how fast we forget those concerns. However, those concerns were never grounded in reality, as we continue to hit record high consumption. And despite China's weakening economy, they hit record high consumption. And the IEA today revises up 2024 expected oil consumption growth. So you do with that information what you will. Yes, there has been some supply increases, particularly in the United States and in Brazil. Unfortunately for us, we own some of these companies that are increasing supply. I don't see a reason not to own these fine cash flowing businesses. A lot is coming from the United States and Brazil. Devon Energy has 10%, as of the last earnings report, which I believe came out last week, 10% year-on-year production growth per share. So that is production growth plus share buybacks. You're producing 10% more per share. Seems like a pretty good deal to me. You find me somebody who has a perfect track record pricing the price of oil. Okay? as Charlie Munger and Warren Buffett say, saying volatility is a measure of risk is crazy. That's what they say. That's what Warren Buffett and Charlie Munger say. Let's see if we can pull up that exact Charlie Munger quote, Charlie Munger volatility quote. Let's pull that up right now. Using volatility as a measure of risk is nuts. They have been buying lots of oil companies. This is Warren Buffett and Charlie Munger. They're net sellers this year, but they are net buyers of oil companies. So do with that what you will. I'm bullish on the sector. I'm perfectly comfortable in volatility in earnings from quarter to quarter. Like we said, PBF, $6 in a single quarter. Not expecting them to repeat that, but that would be a phenomenal year. They got that in a quarter. They had a quarter like that last year. So they'll still be profitable. All other quarters, I think they're going to be just fine, being essentially debt-free. Apple has very volatile earnings, believe it or not. They make 50% more earnings in Q4 than virtually any other quarter. So don't be turned off by volatile earnings unless you want to not study the works of Charlie Munger and Warren Buffett. You do you. That's today's video, and until next time, peace out.